Welcome to the Property Voice Podcast, helping you to navigate safely through the world of property investing. Get the lowdown and updates, insights and outcomes on all matters property with a splash of entertainment along the way. The Property Voice, a voice to trust among the crowd. Now, let's get started with your host, Richard Brown.
Hello and welcome to another edition of the Property Voice Podcast. My name is Richard Brown and as always, it's a pleasure to have you join us on the show today. Now, if you've been following the episodes in sequence, it will not have escaped your notice that so far, we've been aligning the topics to sections in my book, The Property Investor Toolkit. However, I have noticed that an extra couple of topics would be useful to include in this first series that were not explicitly included in the book. Well, they weren't included as separate sections, at least. Now, the first of these we shall go through today, and then another one next week. So, fresh content just for you, if you like, and it rewards your loyalty for sticking with us for so long. Okay, Kaza, how are you today, and what's happening?
Hi, Richard. I am right on the money, thanks. Although, I did see someone make a comment in a forum that they were not so sure about my contribution to the show. So, I suppose I am feeling a little down in the data dumps about that, to be honest with you. Never mind, I heard a quote recently that if you are not being criticized, then you are probably not trying, so try I will, lol. Briefly then, we can look forward to lots of great content related to money and funding our property investments. Richard, you are about to share with us the main ways to fund our investments in Property Chatter. Then, in your voice we have a short and sweet listener review. Finally, 3 for the price of 1 resources in the shout out to look forward to as well. Not bad, is it? Lots of Brucey bonuses in this bonus episode to the first series. So, back to you, Richard. Do you still have your pebbles and buckets after last week's show?
Okay, so let's get on with this week's featured topic with Property Chatter.
Well, thanks for your concern, Kaza. Yes, I do still have my pebbles and buckets, thank you. I thought they were very illustrative for what is actually an audio format after all, but we shall have to see what the listeners made of it before passing any final judgment. Are you still with us out there, listeners? But on a more serious note, it seems that somebody has had a go at our lovely Kaza, have they? Well, don't worry, Kaz. I have heard plenty of high praise about you over the course of the series, I can tell you. But that all said, we'd love to hear from our listeners. Who likes Kaza then? Do we have anyone prepared to step up and defend her honour out there? If so, speak up and bite back if you are. Sorry about the joke. Oh dear, sorry, I better get my serious head back on. But yes, back to the topic in hand. We do have some serious content to go through this week, and it's another topic related to money, and it's all about funding our investment properties. So here goes. Now, despite what most people, well, not most people actually, despite what some people say, to invest in property, we will actually need some investment funds. Most of the time at least. And in today's episode, I plan to give an overview of the main methods of funding an investment property. However, it's such a large topic, I may return to it at a later date in a future series. But suffice to say, for today, I'm going to cover an overview of the subject. Now, investment property financing has come a long way. Until 1996, there was no such thing as a buy-to-let mortgage. Most investment property was bought using cash or commercial financing from banks. And commercial finance was generally not widely available, and so the idea of buy-to-let was not really commonplace with the average man on the street, so to speak. But in 1996, the term buy-to-let was actually coined as a marketing term by ARLA, the Association of Residential Letting Agents. And it was a specific description of financing properties which would be rented out effectively in the private rented sector. Now, this initiative, along with the abolishment back in the late 80s of the Rent Act, gave birth to what is now known as buy-to-let and the private rented sector, or rather, it's mushroomed, exploded the private rented sector. Obviously, there was one before, but it certainly led to the significant growth and a renaming of the sector. And it meant that individuals could own property and rent them out far more easily than they could in the past. And since then, the private rented sector has grown steadily from less than 10% of all properties back then in mid-90s to nearly 20% today. And that's a doubling of the size of the sector in a relatively short period of time, and not forgetting of which, of course, this requires quite a significant amount of investment. One of the most inexpensive things that you can invest in from a private individual point of view, at least in the UK. And the biggest loser, if you like, which fell by the wayside, was social housing. And that was really because public funding was gradually reduced over this same period. And added to which, more recently, home ownership levels have started to slide. They did rise and they peaked at around about the 70% mark before the last housing crash in 2008. But since then, with the mortgage market review, or MMR as it's called, in the residential market, and less investment available in the social rented sector, buy-to-let has taken up most of the slack, with individual private landlords accounting for the large majority of properties in the private rented sector. And according to the National Landlords Association, some 70% of these properties are owned by what are classed as amateur landlords. It's a bit ambiguous what is the definition of amateur landlords, but essentially it's a landlord where they don't earn all of their money from investing in property, and indeed have a small portfolio, probably less than 3 properties. So I think that's the definition in all honesty. So it's quite a large number, and many of these, of course, would have gained access to the market through the changes I've just referred to. So the coming together of finance products, along with the shortage of supply in the rented sector, effectively gave birth, or mushroom growth, to a whole industry. And sometimes, of course, it's attracted controversy, but that debate is for another day. So today it's all about how we can get involved in property investing and the options that are available to fund our investments. So let's start by looking at the main options when it comes to funding our investment property. And what I have in front of me, which obviously you'll have to picture in your own mind's eye, is a table. And effectively, imagine 3 columns in a table. And I'm going to label that the funding source or funding method, the key benefits, and the main limitations. So I'm not going to go into great depth, but I do plan to rattle through 8 different categories of funding source. So the rows are the 8 different categories, and the columns are the funding source itself, the key benefits, and the main limitations. So if you can just capture that picture in your mind's eye, it just might make it a little bit easier as you listen to me go through and explain, if you like, the key benefits and limitations of each particular funding source. So, and of course, the show notes is going to have the table, so it's something for you to go and have a look for afterwards. But let's start with probably the obvious one in terms of funding an investment property. In fact, a lot of people don't think of it as the obvious one, but it actually is, and it was certainly historically the case. That's cash. Of course, you can buy a property using our own funds. And of course, the key benefit of that is that we alone decide what kind of investment we're going to make. No one's controlling what we do. We just take that decision. It's a yes or a no for us. Nobody else is basically saying what we can or we can't do with our own money. But there's no restrictions on how it's invested. And of course, we can use some bargaining power through speed of closing a transaction. So, if you've ever just watched somebody approach an estate agent or a vendor and use the word, well, I'm a cash buyer, it brings about a sense of urgency. It means, people can get out and get on with their lives a lot quicker. And so, of course, that comes with that some bargaining power. And so they're the main benefits, if you like, of using cash. But on the flip side, some of the limitations are that it's finite. There's a limit in the amount of cash pretty much anybody's got available, for that matter, even if your name is Lord Sugar. So at some point in time we are going to run out. And of course, another key benefit which I've highlighted in one of the previous episodes as property as property as an investment is there's no benefit of leverage with cash. The cash we use is the cash we use, and there's no leverage effect by adding in other people's money into the equation. And of course, cash is not a tax efficient strategy. Now, I've said before that we shouldn't, use tax to drive what we do in property, but there are certain benefits of financing that are more tax efficient. And of course, one of the limits of cash is that it is not so tax efficient. So after cash, what might be the next stage potentially that we could look at? Now, I'm not saying the most common, but the next, and that's probably friends and family. And I mention it next because it's also, kind of a friendly source, if I can call it that. A friendly lender, it's often flexible because we can agree terms that are agreeable with, somebody who is, closer to us and understands us and hopefully trusts us. They wouldn't be giving us their money if they didn't trust us, for sure. And of course, it's also fast, assuming that they're also using cash to help fund our investments. And at this point in time, it's probably worth highlighting that from now onwards, all of these funding sources are effectively using other people's money. So in this case, the friend or the family member is the other person. So with cash, it was all our own money, and now we start to look at bolting on other people's money. But there are some flip sides, to the friends and family side, and one of them is probably the most obvious, which is potential damage to the relationship. Things were to go wrong, it could put some strain. And of course, it's still limited in amount, and even, 2 Lord Sugars is still going to have a limit in terms of the amount of cash that they will have available. And there's an element of risk transfer which passes from us to the friend or family member, which can be a bit difficult if things were to go wrong. So we're then involving someone close to us, a relative, in our own investment decision making capabilities. So it can put strain on the relationship, but it can also put even if there's no strain on the relationship, it could put someone in a bit of a difficult spot. So we do need to be careful that if we're following this route to do extra due diligence, really, because it's not just our money in this case, or indeed an institution who's used to looking at investment propositions. It is actually somebody known to us, so we need to take extra due diligence in this case. So once we've considered our own cash reserves, and potentially, I'm not saying we always go and look to friends and family next, but I mention it second because it's a friendlier source. But so the most common route is one I've already mentioned in the introduction, really, and that's a buy-to-let mortgage. And I've kind of explained where that came about. Now, the benefit really of using a buy-to-let mortgage is that, if you like, it's conventional and it's established. I mean, admittedly, for only 20 years, but it is an established part of the industry now, and so that's a good option. And of course, there's plenty of lenders out there now. It's quite competitive. I seem to think it was upwards of 40 different lenders and upwards of several hundred actually different products available now. So there's lots of competition, there's lots of lenders, and there's lots of funds available. So there are the benefits. And I think the other thing is it's actually, relatively speaking, cheap. Buy-to-let lending of late is not quite as cheap as residential home lending mortgages, but it's still very cheap, as we'll see later on when we go into a little bit more depth. But on the downside, I guess that there are certain restrictions, and one of those restrictions is on the loan, what's called the loan to value. So how much the lender will lend you as a percentage of the purchase price is the loan to value. Another factor, of course, is the lender criteria. So a lender will look at the proposition, they will look at you, and they will decide whether they like you or they don't. And I'm going to go into the lender criteria a little bit more later. And the other thing is that it's sometimes unsuitable for certain investment propositions, and again, we'll see that later on. So if it's fairly standard, it'll be okay, but under non-standard situations, it's not always the best route to follow. Next up, we get the commercial finance as a route. Now, of course, pre the buy-to-let era, financing era, commercial finance was the de facto source of funding if it wasn't cash, and so it's well established. I guess that's the point there. There's a large pool of lenders. There's not actually probably as many as the buy-to-let lenders, because a lot of mortgage providers also offer buy-to-let. Commercial lenders is the banks and a lot of financial institutions. But so there's a large pool of lenders, and it's suited, particularly to commercially orientated projects. So it's slightly different from buy-to-let. You can use commercial lending with, residential purchases, but, when we start to look at alternative investment propositions, commercial lending perhaps comes into its own, as we shall see. Similarly, on the downside, as with buy-to-let, there are restrictions, and one of those restrictions is, again, loan-to-value. So it's very rare to get the full project funded. In fact, commercial lending is probably slightly less generous, in fact, than buy-to-let lending on average. There are obviously variations between lenders. Similarly, there's lender criteria, and lenders set their own individual criteria, so it makes it quite difficult to work out who's the best lender for any given proposition. And commercial finance is often restricted. It's a bit of a limited market for what's called experienced investors. So a first-time investor might struggle to get an approval from a commercial finance provider. So a bit of experience under the belt is required to access this particular marketplace. The next category I've got here is bridging finance or auction finance, and they're kind of the same, even though that perhaps they're given different names. They're effectively short-term lending products, and so the benefit, if you like, of bridging finance or auction finance is that it's fast. I mean, obviously, if you're buying at auction, many auctions require completion within 28 days. Some are slightly shorter, in fact. Some of them are slightly longer, but on average, it's about 28 days. So that's pretty quick. And so conventional buy-to-let lending is it's very unlikely going to get that approved and drawn down in 28 days. Now, there's usually more relaxed criteria, and we'll look at this in more depth later on, because the lender is more concerned with the property than they are with the actual borrower. So that's the reason. And it's well suited to short-term projects, and we'll see the reasons for that later on. But if you've got a short-term project, bridging finance, auction finance is possibly well suited. Now, it could be expensive. Certainly, if we look at the interest rates, we'll see that later on, that they're a lot higher as an annual rate when compared with some of the other property financing solutions I've mentioned earlier. But expensive is one of those words that say, well, it depends, because if you're in and out of a project in 3 months, then what's expensive? If it's a higher annual rate, it doesn't necessarily mean the cost of financing over a short period of time is really that high. So expensive by interest rate terms, yes, but not necessarily when you look at the actual total project life cycle. Now, there is one particular aspect here that comes into play, and actually, to be honest, I've meant to mention it earlier with commercial finance on the downside, is that the lender always has their own legal people advising them. So we've got our legal people, and the lender has their legal people, and that basically means two things. It slows the process down, and it also adds to the cost, because quite nicely, the lender passes on their legal bill to us as the borrower. So there's some hidden fees in that, and that can come about. So it can be, and the lender here as well, the bridging lender, they've got a reputation of perhaps being a little bit more brutal if things go wrong. So maybe the earlier examples you could negotiate, but with Bridger you can negotiate, but they can be brutal, and they've got pretty onerous terms and conditions. So then we've got what I call new or disruptive lenders. So far we've been talking really about institutional lenders, the banks and high street lenders and other financial institutions. But when I say disruptive lenders, this whole sharing economy is emerging, and some examples of this are peer-to-peer lending and indeed crowdfunding. So they're new and they're emerging, and they're somewhat unknown. We'll come to that in a minute. But on the positive side, it's an emerging lender pool which might potentially fit the right risk and rewards of projects to suitable investors. So that's quite good. So if we've got a high risk project and an investor looking for a high risk or high return, maybe they're quite well matched. So I think as a marketplace, it's quite a good idea. The idea, of course, is that it's the digital age and the sharing economy, and so that can lead to online applications. So it just streamlines things. There's no interview with the bank manager type of thing required here. So that's another potential benefit. But on the downside, they are, at the moment at least, in my experience, they're still very much bank criteria driven. So a lot of these people have come from the banking industry who are working as credit underwriters and senior people in a lot of these crowdfunding and peer-to-peer lenders. And so they're still doing underwriting and they're still taking credit checks. And, I think there's a little bit of a differentiation that's required for this market to mature and really distinguish itself. But needless to say, they exist, and they have limited experience in the sector, and obviously limited funding resources as well. They're not as big as the big banks. They don't have the same ability to leverage, from savings and deposits to grow their investment funds as the banks do. So, obviously the funds are limited, and so they're scarce. And as I mentioned, as I've alluded to, they're not really yet differentiated from the mainstream just yet. But I probably expect that to change over the next few years, so that's definitely one to keep an eye on. And what would be really interesting is if they've got no credit application, no credit underwriting and this sort of thing, or higher loan to value, different propositions which might make it more appealing to a property investor. And I'm sure all that's going to come at a cost, but it will be a niche in the market, one to watch. The next category I've got listed here is private finance. And private finance it includes joint venture finance partners. Now, friends and family could be an example of private finance or joint ventures, but I've decided to put it as a separate heading because what I'm really talking about here is people outside of that circle. So people we might network with, for example, or there are some smaller boutique lenders who can put you in touch with high net worth individuals to lend on certain transactions. So that's what I'm talking about here. Now, they're potentially more personal because obviously they're individuals, even if there is an organization that fronts them. So they might be looking at more personal criteria. They may be more flexible and fast, actually, in the way they operate. So they're definite plus points. And I think the other thing is that because they're non-bank lenders, their credit terms could be more attractive, and that's something to consider also. But as with the limitations elsewhere, there are certain limitations with these providers too, and probably the biggest one is cost. They're private lenders probably looking for a decent return on their investment. For an individual, property lending or lending to an investor might be seen as higher risk, and so they're looking for higher return as well. But finding the partners, finding these people is also not easy. You don't just walk out and see a shop, on the high street which says private lenders are us, and walk in and immediately get a bunch of financing. No, they're harder to find, of course. And then of course we've got to negotiate individually with them. We pretty much know what we're getting with the high street banks and that sort of thing. But with these private lenders, it's up to them, what they're looking for, and different things will appeal to different individuals. So a personalized conversation and negotiation is required. And probably a little bit like the bridging lenders, the terms and conditions that they will require and potentially the level of security and disclosure might be quite high. They might be looking for guarantees, additional security. They may have rights to walk in your position if things go wrong. So it can be pretty heavy-handed if it were to go wrong. So there's a plus side, but there's also a downside with some of this lending source. And then the final, source, if you like, I've got mentioned here. And when I say it, you're going to realize I'm not going to go into a lot of depth, but it's what I call creative financing strategies. And that's things like rent-to-rent, lease options, installment contracts, and that type of thing. So I'm not really going to go into a lot of depth because they're effectively creative property strategies in their own right. And I think it's worth going into more depth on a later episode. But I want to flag it because it's worth mentioning here that in many cases one of the advantages that there's either low or no own funds requirement with these types of strategy. And if you ever hear about the property investment community and courses and training and this sort of thing, you're going to hear a lot about rent to rent and lease options as being no money down or no money left in type of deals. So it's true that the entry level for funding with these strategies is low, or it can be low. So that of course allows us to have maximum leverage, low funds in for at least controlling an asset, sometimes controlling and owning in the future an asset. So that's a definite benefit. The other one, of course, is that pretty much the credit standing or credit rating of the investor concerned is pretty much irrelevant, unless, of course, the other side of the transaction decides it is important. But generally speaking, they won't. They want to know that they're going to get their money, and so on. So that's the plus side. The downside is it's still very much an unregulated area, and a little bit like a few years ago we had a scandal, if you like, in what's called sale and rent back, where people were buying homes off people in fairly dire situation and renting it back to them immediately. So they didn't move out; they stayed in their own property, but they'd sold it to an investor. And a lot of cases, well, not a lot of cases, but certainly in some cases, some of these people were vulnerable and they were taken advantage of. So that became regulated. But rent to rent, for example, if I just mention that particular area, is not a regulated area at the moment. And when there's no regulation and there's high opportunity, there is sometimes opportunity for things to go wrong. So similarly, finding suitable funding sources, which is basically people willing to offer these properties with these creative strategies, is going to be a challenge, just like with private investors or joint venture partners. And often the structures are a bit complicated and therefore difficult to explain to vendors and other property owners, and therefore to gain acceptance. So they're the downsides. So if I can summarize some of the top tips really to take away from this, is that we're going to need at least some money to invest in property, and even if someone tells us about no money down deals. But this money doesn't always have to be our own money. The concept of other people's money is what I've been mentioning for most of those strategies. But a word of caution, we must disclose the source of any deposit funds to lenders, traditional lenders, to avoid any risk of mortgage fraud. So a lot of lenders won't allow us to use borrowed funds as a source of deposit, or if they do, they'll, they certainly won't want any security taken on the property rather that's being purchased. Word of caution there, really. And some form of lending is actually preferable if we want to get some valuable leverage, of course. So cash, we don't have any leverage, but all the other options, there is some leverage, and of course that can help grow and multiply our returns. Now, some lending sources are particularly well suited to certain types of project as well. So we just need to make sure that we try and align the funding source to the project concerned and indeed our own personal circumstances. And then some of the advanced strategies that I kind of just touched on right at the end are really not for the faint-hearted, and an awful lot of due diligence is required before we dive into that too deeply. Okay, so despite there being at least 8 alternative funding methods that I've alluded to, and in fact there's quite a few sub-methods, if I can call them that: rent-to-rent, lease options, installment credits, installment contract is what I meant to say, to fund our investment property. By far the most common are buy-to-let mortgages, commercial finance, and bridging finance, or auction finance as it's sometimes called. So let's just have a quick look at those characteristics of those three. Now again, I've got a table in front of me, and if you can imagine, I've got a list of criteria down the left hand side. I've got 4 columns. I'm going to look at buy-to-let, commercial loans or lending, and bridging finance as the 3 additional columns to the right. Now, I'm not going to go individually line by line, but I'm just going to highlight, if you like, some of the differences in some of the criteria. So starting with what's called loan to value. So again, this is percentage of the purchase price that the lender is willing to advance. It's called loan to value. So often the most generous is going to be a commercial lender. Not a lot of difference, to be honest, between that and buy-to-let. Up to 80% with buy-to-let, slightly more maybe with a commercial lender, 85% at a push, but there won't be many lenders doing either the 80% for the buy-to-let or the 85% with the commercial lender. So, starting out 40-50% loan to value and going up to that level. Things are very different now than they were in 2007, and there was even a case of 120% finance, loan to value rather, at that point. But bridging and auction finance slightly less generous, so probably a maximum of 70% of the purchase price in that case. It's possibly worth mentioning with a commercial lender that sometimes you can have a valuation based on what's called bricks and mortar, which is kind of the purchase price, or alternatively it could be what's called an investment value. So if you've got an HMO, for example, then a commercial loan might suit itself best to getting a higher valuation looking at the investment value. But it's not as simple as that. There are quite a lot of criteria, and people do sometimes come a crop of thinking they're going to get a higher valuation than perhaps they do. So I'll just point that out without going into great depth. In terms of fees, we've seen quite a change actually in fees over recent times. I think banks have been tightening up on their balance sheets and this sort of thing. So basically they want more fees, and the across the board the average is probably around about £2,000 to £3,000 on occasion, probably escalating in scale between buy-to-let, commercial lender and bridging financier. And with the latter two, the commercial lender and the bridger, there is also these duplicate legal fees that I mentioned before. And then there's a whole host of other fees that get, mixed up. There's admin fees, valuation fees, early redemption charges. So when we're looking at any type of proposition, funding proposition, we need to look at the total cost of finance, as I call it, over the expected term of the investment. So that's just a pointer. And in terms of interest rates, again, we're going to start low and end up high. So buy-to-let lenders are the cheapest source of funding, and the bridgers are the most expensive form of lending, certainly on an interest rate basis. And commercial lenders usually link to LIBOR because it's more of a bank-to-bank lending product. So slightly different way in which they calculate charges. Then we have the repayment term. Now, buy-to-let is quite well established, and most of the time they're 25 years, sometimes 20-year repayment terms. Commercial lenders will actually lend from as little as 3 years, in fact, up to 25 years. So just something to keep in mind, that is that there could be a shorter term involved. But by far the shortest term is going to be with the bridging finance or the auction finances, and that can be anything from 3 months minimum. It's unlikely it's going to be 3, but a 3-month minimum up to 24 months is probably the space for a bridging lender. So you can see where things are starting to be most suited. And in terms of the repayment type, i.e. how you repay the lender back over time, now the interest-only option is more dominant in buy-to-let. You can still get capital repayment, but a lot of investors are now looking at this interest-only, and that's quite a common product with buy-to-let lenders. But with commercial loans, it's probably the other way around. There's probably more of a preference for the capital repayment to be the lead product, and then to a lesser extent, interest-only. You can get both with buy-to-let or commercial loans, but the mix is slightly different. Now with bridging finance, that can be quite complicated because there's all sorts of things there like interest only, which you're probably aware of, but there's what's called rolled up interest. So it's basically all the interest paid on redemption. Not many lenders do that, but some do. Of course, that's great from a cash flow point of view. Not so great from a total interest point of view, because obviously you're going to be paying a lot of interest by deferring the repayment. And then they have sometimes, conversely, they have what's called interest deduction from the advance. So if you take out a 6-month product, they may deduct the whole 6 months worth of interest from the advance. So it's extra money you've got to find at the front end. So very much, check out those terms if we're looking at that route. Now, in terms of lender criteria, the first two categories, certainly buy-to-let, they're usually looking for people who've got an income outside of property income. So they're probably in employment. It's sometimes a professional landlord, but predominantly in employment. Usually a homeowner and with good credit ratings, and there'll be a limit on the number of properties that they have. Now that starts to change as we move across the columns, if you like. So commercial lenders might take more of a view. Perhaps they'll take into account rental income as part of a minimum income requirement. Perhaps they'll say, well, we're happy for you to live in a rented home of your own, providing you have an investment property. So perhaps a bit more flexible moving to the commercial sector. And by far the most flexible is going to be the bridging lender or the auction financier, because they're really most interested in the property and less interested in the borrower. It's not exclusively not interested, but they're going to be less interested and therefore less picky in that respect. So and then the other thing is really in terms of the type of property that are best suited for those types of lender. Now, standard homes in a fully lettable condition says buy-to-let mortgage straight away. But if there's something a little bit different, perhaps there's some refurbishment works that are required and that type of thing, or maybe it's a property above a shop, that type of thing, commercial lenders are going to come into their own, and certainly HMOs, as I've already alluded to, may be more in the space of a commercial lender. And then as far as a bridging finance company is concerned, pretty much anything goes, really. And so that if you've got an unmortgageable property, i.e. hasn't got a kitchen or something like that, then a bridging lender is potentially where you can go for that type of funding. So I guess, if I were to summarize the top tips from that takeaway, it's really to match the right finance opportunity to the right property and indeed our own set of circumstances. And you can probably see from some of the criteria that longer term projects are going to lend themselves to buy to let, short term to bridging finance, and HMOs say to commercial lending. So it is a case of matching the right product. And one thing I really should point out is that the best deals are going to be available by using a finance broker, but not all finance brokers are equal. So make sure if we're looking at residential buy-to-let or commercial or bridging finance, that we go and find a broker that specializes in that area, and they've got what's called whole of market coverage to get access to the best opportunities. And brokers do generally add value, but always get a recommendation is probably the best thing I could say there. And probably my final point to make in this section is that I'm just going to make a bold statement that valuers rule the world. It's a bold statement, and I think anybody who's been involved in property investing for any period of time will know that valuers really do control what ultimately gets lent out. Then, second of all, credit underwriters in the lender. So, as a pair, they're pretty formidable, and we need to work with those people if we're going to be successful and get valuations and the lending that we require. So, just a point there. So what we're noticing, I guess, is that some of those lending solutions, they're going to present themselves as our experience grows. Now, we're probably going to start with bread and butter buy-to-let mortgages when we first start investing, but as we get more experience and we see more opportunities to invest in different types of project, alternative projects are going to appear, and therefore alternative funding sources are going to appear as well. So we're going to see ourselves grow in that respect. So I'm actually a bit conscious. In fact, I'm probably skipping some of the things I wanted to say because it's not going to do it justice in this episode. So I'm probably going to draw this to a close, and we're going to revisit the whole subject of financing later on. But hopefully that's given something of an overview of the different funding sources available, a little bit of a deeper dive into the differences between some of the mainstream funding sources that constituted buy-to-let, commercial lending, and indeed bridging or auction finance. So hopefully that's helped a little bit. But in the interest of speed and trying to give something back to you, I'm probably going to hand over to Kaza now for Your Voice.
Up next is Your Voice. It's all about you and your property world.
Today we have a listener review to share from CPPP10. Here is what they had to say. Very helpful. 5 stars. Richard Brown, the host, is very engaging and professional. The podcast is very structured with a lot of great information and insights. Well done. Thank you for that great review, CPPP10. We really appreciate that. Back to you now, Richard.
And now, where you can go for more great resources with the shout out.
So just before the shout out, I just want to say a quick apology to Julie in Chiswick. I know you left me a voicemail and I prepared an answer for today's show, but I'm going to have to defer it till next week. So if you wouldn't mind tuning in next week, I will gladly share your question, which is all about pensions. So sorry about that, but probably too little time available today. So in terms of the shout out today, I'm going to keep it bang on topic and trying to bridge the reference a little bit. I've got mortgage calculators on my mind. Obviously, we've been talking about finance and mortgages and that sort of thing for investment property. I haven't just got one, I've got 3. So I've got mortgage calculators from Property Tribes, Property1.09 and Money Facts to share with you today. So they're all going to be linked in the show notes, so head on over to them and you'll find those. So just one thing, some of those partners actually link to mortgage brokers in their own right, so just keep that in mind, that they may link through to a mortgage broker. So you may have your own broker or recommendation that you want to pursue, just sort of flag that in any case. But one word, always look for whole of market brokers. That's ideal. And if not, then certainly those who specialize in the area that you're particularly looking to invest. So basically we've been looking, at the money side of things today, and in terms of funding the investment. And of course, so much about property investment is either enabled or facilitated by access to adequate and indeed appropriate funding. And I hope that's given a flavor, admittedly probably on a whistle-stop basis, for this topic for you to draw upon. So talking of drawing, we're actually drawing towards the end of this first series of the Property Voice podcast, and what I'd be very much interested in is what subject areas you probably be like for me to cover in subsequent series. Now, I'm trying to group series in terms of a collection of subjects, and so we can go into a little bit more depth. I kind of alluded to finance as being a big area, and I think we can go into a lot more depth in that. But what are you interested in hearing about? I would be keen, and if we can incorporate it into a future series, we'd certainly like to. So drop us a note, get in touch. That'd be great to hear. The show notes are going to be on the website as always, so please check that out and do start a conversation with us. But once again, I'd just like to say thank you very much for listening. It really means a lot to us, because pulling the show together is quite an effort actually. The research and the time involved and the production team behind us. There's a lot to get through. So we really do appreciate you listening, but we also appreciate your engagement. So please do get engaged. But right now, for another week on the Property Voice podcast, it's ciao ciao.
Ciao ciao.
Thank you for listening today. Now head over to thepropertyvoice.net for more inspirational content and get updates through our mailing list. Join us next time on the Property Voice podcast. And if you enjoyed the show, please don't forget to rate us on iTunes.